advanced capital budgeting. And for capital budgeting, this involves commitment of funds. This involves commitment of investment funds, long-term projects, which returns are expected to be realized in the future. That's all about the capital budgeting. It involves commitment of investment fund to long-term projects of which the return are expected to be generated in future. So therefore, what are the some of the characteristics of capital budgeting projects? Capital budgeting projects. So one of the characteristics of this long-term capital budgeting project is, number one, is the nature of the period. So they are long-term. Then number two, it involves or it requires huge capital. Another characteristic is that when do you expect the returns? The return expected in the future. Returns are expected to be realized in the future. Yeah, now if the returns are expected to be realized in the future, and in this case you have no control of the future, that means there is that aspect of uncertainty. And therefore this means the project are very what? They are risky project. Are you together? And then number five, they are irreversible. Irreversible, that means once undertaken, it's very hard to abandon that project. Because number one, when you are taking that project, it involves a given, you had invested a lot of capital. So it becomes difficult for you now to reverse that project or to abandon that project. So what are these types of capital budgeting projects? Type of capital budgeting project. And number one, we have mutually exclusive projects. When you talk about the mutually exclusive project, they are projects serving the same purpose. And if they are serving the same purpose, therefore they act as a substitute. That means if one project is undertaken, the other project automatically are abandoned, are not undertaken or they are abandoned. Right together. So in this case, we're saying that they are projects which serve the same purpose. Therefore, if one is undertaken, the other one is automatically rejected. Then number two, we have independent project. What do you think are the expected independent projects? Now, independent projects, they are projects which does not interfere with each other. So that means, for example, if you have project A, we have project B, you can undertake them at once and no project will influence each other. That means they are totally independent. Number three, we have dependent project. Dependent means what? They are projects which depends on each other. So for example, you have project A, which depends on project B. If you undertake A, that means you have to undertake also project B. So they depend on each other. Therefore, undertaking of one project, that means you have to undertake even the other project. Then number four, we have what we call divisible projects. And a divisible project, these are projects that can start generating inflows or return even before they are fully completed. Yeah, that means when they are that percent, 40% or 60% through, they can start generating incomes. And then number five, we have indivisible project. Is the opposite of divisible project. Therefore, what's an indivisible project? Is a project which cannot generate income before? Yeah, before it's fully completed. Good. So those are the type of the capital budgeting projects. Mutual exclusive, that's their substitute. Independent, they don't influence each other. Dependent, they depend on each other. Divisible, can generate inflow before their completion, and then indivisible cannot generate inflow until they are fully complete. completed. Good. Now, when evaluating this project, evaluation is all about determining the feasibility of the project, whether to undertake or not whether to undertake. So what are the methods used? So now let's look at what we call project evaluation techniques. What are some of the project evaluation techniques? And those techniques are classified into two. Number one, we have non-discounting and discounting techniques. And number two, we have discounting techniques. What's the difference? Now, for non-discounting techniques, they are techniques which does not take into account time value of money. So in this case, there is no time value of money. But under discounting techniques, they take into account the time value of money. Yeah, so in this case, there is the aspect of time value of money. And this is what now we shall be evaluating. We shall not be evaluating the non-discounting techniques. And for non-discounting techniques, they involve techniques such as the payback period and then the accounting rate of return. But for the discounting techniques, those methods used to evaluate, they include, number one, discounted payback. Yeah, payback period. What do you think is the payback period? Is the time taken to do what? Yeah, is the amount taken to recover your initial investment or your initial capital. Then number two, you can use what we call net present value or NPV. Also, you can use the modified internal rate of return. Also, you can use internal rate of return, as well as there is profitability index. So those are the methods used when evaluating project under discounting techniques. We have the discounted payback period, NPV, modified internal rate of return, IRR, and profitability index. Good. So now let's start with the first one, which is the discounted payback period. So we are saying that in this case, we'll only be evaluating under discounting techniques. So we'll not be evaluating using the non-discounting techniques. So I'll start with the first one, which is the discounted payback period. And we are saying that payback period is the duration taken to recover your initial capital. And then the shorter the payback period, the better and less risky the project. Yeah, because for example, if you're given two projects, we have project A, project B, with the same amount of capital of 10 million, but the payback period for project A is 5 years, but B is 7 years. Which project would you, assuming both of them, they are mutually exclusive? Which one you want to take? 5. Yeah, the one where you realize your capital within a shorter period of time. Eh? So you're saying that the shorter the payback period, the better and less risky the project is. Good. So now let's go back to the notes. Take out your notes. Discounted payback. I'd shared the notes with you. Eh? The one, actually, I only shared the handout, the mergers and acquisition, and the other one you have indicated advanced financial management. That's what the first topic is. Eh? That means that handout actually carries 3 topics, even the replacement analysis in that topic. Good. So, and what you have discussed, everything is there. So let's open May 2014, question 2B. May 2014, question 2B. May 2014, question 2B. For those without the past paper, the question is already in the notes, if you have the notes. May 2014. And we are told that we're doing part B. Madara Limited is considering investing in one of the two mutually exclusive projects. In one of the two mutually exclusive. So that means those projects are substitutes. Once you take one, you abandon the other one. So the relevant cash flows of each of the projects are shown in the table below. The firm cost of capital is 15%. Cash flow accrue at the end of the year. So we have project X and we have project Y. You are given the initial investment and cash flows from year 1 to year 6. Required. Calculate for each project, number 1, discounted payback period, 6 months, discounted payback period. So let's start with project X. We need to evaluate the two projects, project X, and you have the period. Then you are given the cash flows. Once you're given the cash flow, you rediscount. So you determine present value interest factor. You told the cost of capital is how much? Yeah, the cost of capital is 15% year end, so that we get the present value of cash flows. Once you get the present value, you accumulated present value. So we have year 1 to year 6. So how much is the cash flows? Year 1 generating 25,000, negative 11, 20,000, 15,000, 6,000, and 5,000. Now those are the cash flow. Now you ask yourself, in case I get this cash now, how much will be the value? That's all about what we call discounting. Yeah? So can you go to the back, at the back of your past paper where you have the tables? Let's go where you have the discounting tables. So at the back of your past paper. The last page I have given that. So in that case, we have the first table and we have the second table. Now the first table is for the single amount or the single period where the cash flow are not the same. In case you are given the same cash flow, that's when you use the second table. So the second table is for the annuity. Annuity, that means that, for example, if from year 1 to year 6, you're generating 25, 25, 25, 25, 25. That's what we call an annuity. Use the second table. If the cash flow are not the same, that means use the first table. So let's go to the first table. 15% year 1, you get 0.15% year 1. 0.8696 year 2, 0.61 year 3, year 4, sorry, 5718, 49, 72, and last we have 0.43, 93, 90, 23, good. So now with that, now let's get the present value. So to get the present value, take the cash flow, you multiply by the discounting factor. The first one is 21,470, 740, 21,740. $83.17. $13,150. Sorry? 77. Sorry? 83 point? Let's work with 83. 2161.5. Now, once you get the present value, now let's try to accumulate those present value. So the first one will be 21,740. Then you add negative 83.17. get 13 for 23. Then 13 for 23, you add 13 150. 578, 573. 573. Then you add 8577. 38. 133 and Rationing. Now, let's go back to project X. How much was the initial investment? Project X, how much was the initial investment? Sorry? This one is? This one? 42, 294, like that, Good. So how much was the initial investment for project X? 38? 38,500. So now let's be here. Let's be here. Now for the accumulated present value. When did we attain 38,500? Is it 38,500? Yes. 38,500 lies in between year 5 and 6. Yeah, this is why we have 38,500. So that means our payback period is 5 years plus a month. How do we get those months? So this is how we get those months. You take the initial capital, you raise the lower limit, then you divide by upper limit minus lower limit. You get them in years, but you want to get them in months, you multiply by 12. So what do we mean? So it is 5 years. Initial investment was 38,500. Then this is the lower limit, this is the upper limit, right together. So you raise the lower limit, which is 38,133. You divide by upper limit, which is 40. You minus the lower, of which difference is 61.5. Yeah. So you take the upper, which is 4294.5 minus lower limit, which is 38,133. Then what you get in points, then you multiply by 12. So it'll be equivalent to 5 years. How many months? Two months. It will be 5 years, 2 months. Now let's do the same now for project Y. Go to project Y. So we get the period. We have the cash flows. Then you will discount present value interest factor, 15% to the end. We get the present value of the cash flow, and then we accumulate the present values. Year 1, year 2, 3, 4, 5, 6. What do we have? Year 1 we're generating 30,000. Year 2, 8,000. Year 3, -4. Year 4, 22. Year 5, -10. And then we have then we'll discount using this first table. That does not change. The same here. Year 1 was 0.8696. Kindly be multiplying that. $26. 60. 49. 26, 30. 12.5. 7. So let's call it 80. This one is negative 49.72. For 84.5. So once we have the present value, now let's accumulate that. Let's accumulate that. So the first one will have 26,088. Then you add 6049. That to 137. Then you add, or you minus 2630. 29. 507. Then you add 12,580. 0.87. Then you minus 49.72. That's 7. 114. 115. Then you add 64.84.5. 5. Then you ask yourself, how much was the initial investment? How much are we investing in project Y? That's 7. That's 7,000. So now let's go to the accumulated present value. What does it fall? That 7,000 falls in between. Yeah. 3 and 4, eh? Yeah. Yeah, 3 and 4. That's why you have that 7. So that means our payback period will be 3 years. To get the months, we see that you take the initial investment, which is 37, minus lower limit, which is 29.50. Then you divide by upper limit minus lower limit, of which the difference between the two is 12.58. Yeah, 12.58. Then what you get there, you multiply by 12. So it will be 3 years. Seven months, eh? Yeah, 3 years, 7 months. So remember, you are told that the two projects were mutually exclusive. So between project X and project Y, which one do you prefer? You want to take project Y and I take project Y, since it has a shorter payback period. Are you okay up to that? Good. So that was one of the methods you can use to compute that. Then another project evaluation technique is the net present value, NPV, which is the most widely applied method. And what's NPV? Net present value is just the difference between the present value of cash inflow and the present value of cash outflow. Yeah, as the formula says that to get NPV, you take the present value of cash inflow, you raise the present value of cash outflow. Then what are the decision criteria? Decision criteria. So if NPV is positive, that means the inflow are more than the outflow, you accept. But if NPV of that project is negative, you do what? You reject. What about if you are evaluating two mutually exclusive projects which are both viable? Viable, that means that the two projects are mutually exclusive, but they are generating positive NPV. But you need to select one. You select one with the highest NPV. So in case the two projects are mutually and both of them they have a positive NPV, you take the one with the highest NPV. So I want to use the same question to evaluate these two projects. Now to determine which one to accept. So how can we evaluate this? Now this is how we evaluate. So nothing will change. You just take the period, take the cash flow, you rediscount, then you get the present value. Once you get the present value, you add the total. Can you add the total present value? Don't take a calculator. You have them here. That's why you accumulated them. The total is how much? 4294.5. So in this case, we don't need that column. Once you take the cash flow, you discount to get the present value. Once you add the total, what you get is the present value of cash inflows. So to reserve, I have said that to get the present value of cash, to get the NPV, you take the inflow, you deduct the present value of cash outflow. In project X, how much had we invested? Yeah, the initial investment was that 8,500. So how much is the net present value? Sorry? $1,794.5. Yeah, when you get a positive, that means that project is viable. Now let's go to project B. Project B, you do the same. You take the period, you take the cash flow, you discount to get the present value. Once you get the present value, you add the total. So the total is what you call the present value of cash inflow. How much is it? If you add the total should be 43,500. It was 98.5. Then you deduct present value of cash outflow. How much had you invested in project one? Yeah, the capital was 37,000. So that means the net present value will be an amount of 65,99. Good. Now you can make your decision. Remember, the two projects were mutually exclusive. That means you need to select one. Between project X and Y, which one do you undertake? Yeah, you want to take project Y, since it has a higher NPV. Yeah, you want to take project Y. Good. So that's the net present value. The other method was? Yeah. So that was the second method. The first one was discounted payback period. We have done NPV. Then we have the modified internal, rate of return. That is IMIRR. Now get the difference. There is IRR and there is MIRR. What's the difference? Now what happens under modified internal rate of return? It assumes that the cash flow generated in the cash flow generated can be reinvested back to earn more returns. What do we mean? For example, in this project, now let's take the case of project X. This project you had invested that 8,500, right? In the first year, you got how much? 25. So that means in the same project, you invest again that 25. So that's what we call, we apply the modified internal rate of return, where the cash flow generated can be reinvested to earn more returns. Then what are the sum of the decision criteria? When evaluating with this, using this method, if the modified internal rate of return is greater than the cost of capital, you accept that project. But if the modified internal rate of return is less than the cost of capital, you do what? You reject. But if the modified internal rate of return is equal to the cost of capital, that's what you call the point of indifference. You can either reject or accept. Yeah, point of indifference. So how do we determine modified internal rate of return? So to determine the modified internal rate of return, you'll be taking the future value of cash flows, you divide by the initial investment, which is the same as the present value of cash outflow. Then nth root, n is the period, minus 1. You take the future value of the cash flow, you divide by the initial investment, nth root, then you minus 1. And how do you get the future value? You know how to get the present value, right? Yeah, so how do we get the present value? To get the present value, in case it's a single amount, or when using the first table, it's just 1 plus r raised to power negative And that's how we get the present value. Now, in this case, we're trying to get the future value. So how do we get the future value? To get the future value, you take 1 plus r raised to power n. There is no minus. What about in case it's an annuity? In case it's an annuity and you want to determine the present value, assuming you're given the rate which is not the table, definitely will be provided the table, but that's only for the present value. Eh? So for example, can you check from your past paper, the tables? Do you have 13%? 13 or 11%? There is one rate which is missing there. Eh? Do you have 11? 11 is there. Eh? What about 13? 11 is not there. Eh? Now, if you are told that the cost of capital is 11%, that means the discounting values are not in the table. How do you apply that? So in case it's a single, use that formula. In case it's an annuity, it's 1 plus R, 1 minus over R. That's how we compute that. 1 minus 1 plus R raised to power negative R and raised to power negative N over R. What about the future value? How do we get the future value of an annuity? You'll be taking that amount, the annuity, 1 plus R raised to power N minus 1 over R. Can you note the difference? What's the difference? If you don't know the difference, eh? So now let's do a question. So take out your handout. Take out your handout. I want us to evaluate a question. Handout page 1, question 1. Handout page 1, question 1. So we are told that consider a project whose initial investment is 636,000 and the company expects to generate annual cash flows of 240,000 per annum for a period of 5 years. So that's an annuity. The present value of cash flow can be reinvested at the rate of 16% per annum and the cost of capital is 14%. Determine MIRR to determine modified internal rate of return. And how do we get the modified internal rate of return? You take the future value of cash flows over initial investment, which is the same as present value of cash outflow, and the root minus 1. So let's get the future value. So how much do we expect to generate every year? Yeah, it's 240,000 for a period of 5 years. So you'll be taking 240,000. This one is an annuity. 1 plus R. How much is our R? The rate. Yeah, it's an amount of. Yeah, you take the investment rate, not the cost of capital. The investment rate is 16%. It will be 0.16 raised to power negative. So this one is future value. It's not raised to power negative. It's just raised to power 5. The period is 5. Then minus 1. I've given out the formula. Then you divide by R, 0.16. So give me that. You get? Like that. Then, therefore, you can get our modified internal rate of return. We have the future value of the cash flow, which is 1650,512. You divide by the present value of cash outflow. How much is the initial investment of this project? It's 636. And the root, a period of It was six or 5 years. Then you minus 1. Mm-hmm. 0.21. Mnapata ngapi? I want now individual answers. You're getting how much? 0.21. Yeah, it should be 0.21, which is equivalent to 21 per. Yeah, for those who didn't get 21%. Now this I will get the fifth root because I know that's where most of you are being stuck. If you didn't get that, kindly repeat what I'm doing. Kindly do what I'm doing. 16, 5 or 5, 12. Just do that. 16, 50, 5, 12. Divided by 6, that's 6,000 equals. Now we want to get the fifth root. This I will get the fifth root. You press 5, shift the symbol of raised to power. Just press that symbol for raised to power. Then press answer. You are looking at the fifth root of the answer equals minus 1. Minus 1. Are you getting 0.21? Or I want you to do this for me. Give me the fifth root of 70. Give me the fifth root of 70. You're saying that you press 5, shift, raised to power, then of 70. Or alternatively, you can do this. Alternatively, you can do this. To get the fifth root of 70, you just take, it's the same as 70, raised to power 1 over 5. Are you together? So can you try that? 70, raised to power, open the bracket, 1 divided by 5, close the bracket. Are you getting the same answer? Yes, so that's how we get the end root. So now we go back to this question. Now in this case, our modified internal rate of return is 21. Modified internal rate of return is 21. How much was the cost of capital? The cost of capital was 14%. Is this project viable or not viable? Should you accept or reject? You should accept, since the modified internal rate of return is greater than the cost of capital. Are we together? So I want us to do that question we have been doing from the past paper, May 2014. That question we have been doing, May 2014, question 2B. You don't have to copy what we are doing here. You already have the notes. Question 2B. I want us now we do part 2 of the question. Now in that question of May 2014, question 2B, now let's go to the required. Now let's go to the required. You have to calculate for each project. Now let's go to number 2. Number 2. Modified internal rate of return. Modified internal rate of return. So how do you evaluate the two projects using modified internal rate of return? So you have period 1, 2, 3, 4, 5, 6. We have project X. You can combine both, eh? Project Y. Then you have the cash flows. Project X is generating 25,000. Then your discount, but in this case, we're getting the future value. So future value, you take 1 plus R raised to power n. How much is the cost of capital? The cost of capital was 15. So it's 0.15. 0.15. Raised power. The first one will be how much? First one will be 5, 4, 3, 2, 1, 0. That's how we get the future value. Give me that. You see, this is what we mean. Now let's be here. The cash flow generated at the end of year 1. How many remaining years do we have? 5 years. The cash flow generated at the end of year 1 can be reinvested for the next 5 years. The cash flow generated at the end of year 2, since we have 4 remaining years, we will invest for 4 years. What about the cash flow generated at the end of year 5? Can only be invested for the next one? What about the cash flow generated at the end of year 6? It cannot be reinvested again. Are you together? Good. So now give me that. So that one is 1. That's 1.15. Into 2 decimal places. One point. 2.0 like that. 1.8. 4.2. Someone was saying 4 there. $1.520. Good. So now with the future value, now let's determine the future value for project X, future value for project Y. Just decide to combine the two. So for example, in this case, let's start with project X. You'll be taking 25,000, you multiply by 2.01. So how much is the future value? 50, 275. Now, can you give me the total? Give me the totals. Others to add for X, others to add for Y. Which one? 93, 200. Can't be 93. 50 plus that one, it can't be 93. This is 50,000. This is 30, that's 80 already. Oh, this was negative, eh? Oh, yeah, it can be this negative. It's okay. What about Y? 100? You don't have to compute again. If you have the answer, just give me the answer. 9? 844, eh? Yeah, 0.5, eh? So now we have the total future values for project X and Y. And you have to determine MIRR. And you have said that to get MIRR, you take the future value of cash flows, you divide by the initial investment or the present value of cash outflow, and the root minus 1. So now let's start with project X, then we get for Y. Do we have the future value for project X? Yes, we have, which is 93, 200, and project Y we have, it's 100, 844.5. Then you divide by the initial investment. X, we had invested how much? That 8,500. What about the other one? 37. Then it was for 6 years. Then minus 1. Which one? The first one is? Sorry? 15.87%. 18.19%. Now, note that the two projects were mutually exclusive. Between X and Y, which one will take? You'll take Y. Yeah, both of them, they are viable because the cost of capital was 15%, right? If the cost of was 15%, that means X is greater than 15.87 is greater than 15 as well as 18. That means the two projects are viable. But in this case, they are mutually exclusive. That means you only need to undertake one. You take the one with the highest modified internal rate of return. Good. That's all about the modified internal rate of return. So you can take a break of 2 minutes. Then we come with do profitability index. So you can continue. So the fourth method is profitability index. PI. Now for profitability index, it's just a relative measure of performance, which measures the ratio of the inflows and the outflows. So to get the present or to get the profitability index, we'll be taking the present value of cash inflows, you divide by the present value of cash outflow. What about the decision criteria? For the decision criteria, if profitability index is greater than 1, that means the inflow are more than the outflow, you accept the project. But if the profitability index is less than 1, that means in that case the outflow are more than the outflow, you do what? You reject. Yeah, and then profitability index is applied in relation or where there exists what we call the capital rationing. And what do we mean by capital rationing? Capital rationing is a circumstance where there is scarcity of investment funds to undertake all viable projects. So that's what we call the capital rationing. So let's go back to the notes. We discuss that. So profitability index. And this is a relative measure of performance expressed as follows. And then we are given the decision criteria. Now, PI or profitability index is applied when the company is facing capital rationing. What do we mean by capital rationing? So this occurs where there is a scarcity or limitation of the investment funds for undertaking all viable projects. And we have two types of capital rationing. One is the soft. Number one, we have soft or internally generated capital rationing. And number two, we have hard or externally generated cash flow. What's the difference? Now, for the soft generated cash flows or internally generated capital rationing, is the scarcity of funds due to factors within the control of the management or due to the actions of the management. But for hard or externally, this is the scarcity of investment funds due to factors not within the control of the management. So now let's go back to the note to discuss on that. So there are two types of capital rationing. One is the soft or internally generated capital rationing. And this occurs when there is a shortage of investment funds as a result of action of the management, i.e., the shortage is within the control of the management. It may occur due to the following circumstances. One is where the management refuses to raise additional funds through the issue of shares to avoid what? Dilution. Yeah, that means the company has the potential of issuing more shares so that they can get the capital. But in this case, the management, it's all about fears that aspect of dilution of ownership. We issue the shares, that means we'll have to have other additional shareholders. So in that case, remember, if you have additional shareholders, that means there is dilution of ownership. Then number two, also to avoid commitment of payment of interest in case the company borrows fund. In case the company borrows fund. So we are saying that in this case, the company is creditworthy. So that means they can be able to take a loan. But in this case, the management avoids that. Once you take the loan, there will be increase in the financial risk. That means you have to pay the loan, to pay the interest, right, together. So in that case, they fear. So we are saying that there's scarcity of investment funds due to the factors within the control of the management. Then where the management has set a limit of the budget, and then when the project can only be financed using the internally generated funds. Yeah, that's the retained earnings. And then we have the hard or externally generated capital rationing. And this is the scarcity of investment funds due to factors which are not within the control of the management. This might occur due to the following. Number one, when the capital market is depressed, yeah, thereby making it impossible to raise finances. Also, when the cost of issuing capital is too high. Yeah, the borrowing cost is too high. And then when there is high demand of investment fund by well-established company, and then due to lack of security or collateral when borrowing. So in this case, you have the ability to borrow, but in this case, the bank is asking you, what can you offer as security? But in this case, you don't have. So that one is not within the control of the management. Good. So open that question. June 2010, question 1C. June 2010, question 1C. June 2010, question 1C. So we are told that Kingo Limited is considering 5 project proposals as summarized below. So we have project A to E, initial investment in millions, annual revenue, annual fixed cost, life of the project. Additional information, number one, variable costs are 40% of the annual revenues. Number two, so if the variable cost is 40%, that means the contribution margin is how much? 60%. Project D and E are mutually exclusive. So between the two, you only take one. Then each project can only be undertaken once and each is divisible. Then number four, assume that the cash flows are confined to within the lifetime of each project. Then the cost of capital is 10%. No inflation exists, no risk, no taxes exist, or the cash flow occur on anniversary dates required. Assuming that the company has a limit of 40 million for the investment in project at time zero, determine the optimal allocation of 40 million. You see, in that question, they have not asked about the profitability index, but they have given you the rationing. So whenever you have the capital rationing, know that they're asking about the profitability what? Index. Yeah. If the optimal allocation of 40 million among the projects, and then you compute and the resultant maximum NPV obtainable, 12 marks. Yeah, so whenever you have capital rationing, know the method to use is the profitability index. And we have said that to get the profitability index, you take present value of cash inflow divided by present value of cash, as well as we also need to get the NPV. And the NPV is the present value of cash inflow, you raise present value of cash outflow. So let's start with project A. Project A. Project A How much is the annual revenue? It's 20. You multiply by, or you minus variable cost. Let's go to note number 1. Variable costs are 40% of the annual revenue. So you take 40% of 20. Then you minus, project A has a fixed cost of how much? 5 million. So what do you get as your net cash flows? Minus 5 is 7, right? Are getting how much? 7. Or alternatively, if the annual revenue is 20 and the variable cost is 40%, that means the contribution margin is how much? Yeah, you multiply by 60%, you get the total contribution margin, then you deduct the fixed cost, of which you still get 7. Now, once you get the cash flows, then you rediscount, you multiply by present value interest factor of an annuity. This is an annuity. Are you together? Yeah, it's not year 1 or year 2. This is an annuity. And project A, it has a life of project is how many years? 3 years. Because what you're given is the annual revenue, annual fixed cost. So in short, what you are getting here is the annual cash flows. How much is the cost of capital? Note number 4. The cost of capital is 10. Yeah, it's 10% for 3 years. So now let's go to the annuity table. Use the second table or the annuity table. Use the annuity table. 10% for 3 years you get. Sorry? 869. So give me that. $17.83, eh? Yeah, so that's the present value of cash inflow. Then to get NPV, you raise present value of cash outflow. Let's go back to project A. How much was the initial investment? It's 10 million, right? Yeah, it's 10 million. So our NPV therefore will be 7.4083. So that's NPV. Now let's determine profitability index. You take the present value of cash inflow, which we have 17.4083. You divide by the present value of cash outflow, which is 10, and you get 1.74. Let's go to project B. You do the same. Project B, how much is the revenue? You take 30, contribution margin is 60%, and then you raise the fixed cost of 10. Give me that. 18 minus 10, you get 8, right? Then you rediscount. Present value interest factor of an annuity. Cost of capital is 10%. Project B has an economic life of how many years? 5 years. So it will be 8 times 10% for 5 years. 7. Give me that. That point 324. So that's the present value of cash inflow. To get NPV, raise present value of cash outflow. So how much was the initial investment for project B? Yeah, it was that. So that means our net present value will be 0.3224. Therefore, let's determine the profitability index. You take the present value of cash inflow, which is 30.324, divide by the present value of cash outflow, which is 30. You get 1.0 what? 01. You need to 3 decimal places. 1.01. 1. Eh? Let's go now to project C. Project C. How much was the annual revenue? We have 18. Contribution margin 60%. Then you minus fixed cost. Fixed cost for project C is how much? 6. So give me that. You get 4.8. Then you discount present value interest factor of an annuity. Cost of capital is 10%. And has economic life of how many years? 4. So it will be 4.8, 10% for 4 years. 9? 9. So give me that. 15.2155. So that's our present value of cash inflow. Then you raise present value of cash outflow. So how much was the initial investment for project C? 15 million. So that means to get our NPV, or our NPV will be 0.2155. Now let's get the profitability index. You'll be taking 15.2155. You divide by 15. 1.0114. Good. So that was project C. Now let's go to project D. Project D, annual revenue is 17 million. Then you multiply by contribution margin of 60%. Then you raise the fixed cost of 8. What do you get as our cash flows? 2.2. Then you discount present value interest factor of an annuity. Cost of capital is 10%. Project D has how many economic life? 10 years. So it will be 2.2 times 6.144. 13.5181. So that's the present value of cash inflow. To get NPV, raise present value of cash outflow. How much had we invested? 12. So we'll be having NPV of 1.158. Therefore, our profitability index will be 13.518 divided by 12. 1 point. 1.26. Good. Then let's go to project E. Last three is project E. Project E, we had an annual revenue of 8 million. So you take 8 million, you multiply by 60%. Then you minus, how much is the fixed cost? 2. So what do you get? 2.8. Then you discount times present value interest factor of an annuity, 10%, and project year an economic rate for 15 years. So you'll be having 2.8. 6061. 21.99. So present value of cash inflow, then you raise present value of cash outflow. How much had we invested for project E? Yeah, the capital was 18. So that means we'll be having 3.297. That's our NPV. So how much is our profitability index? So to get the profitability index, you take 21.297, you divide by 18, you get 1.183. Good. Now let's go to note number 4. Note number 4. Sorry, note number 2. Note number 2. Note number 2, I told that project D and E are mutually exclusive. So what does that mean? Only I take one, eh? So now we need to evaluate between project D and E. You can use even NPV, D and E. Project D had an NPV of how much? 1.518. What about project D? 3.297. Which one we want to take between the two? You take project A. That means you drop project D. So in your evaluation, we're doing capital rationing. Analysis will not be, you not evaluate project D. Good. Now, once you have the NPVs and you have the profitability index, remember we have a capital rationing of 40 million. Now, how do we apportion that? We apportion by ranking the profitability index. Now, which one has the highest profitability index? Project A has 1.74. So that is rank number 1. Followed by I only have one student in this class. Hiyo ni kazi ya macho, ni kuangalia tu. Can you look at the profitability index, which is rank number 2? So rank number 2. Then D. D is out. You're not evaluating project D. Are you together? So now we only have B and C. Now between B and C, which one has the highest? It's C. So this one is rank number 3. Therefore, this one will be rank number 4. Good. So now let's do that analysis. How much is the capital balance? Yeah, we have a capital rationing of 40 million. Just read that the question, the requirement. That assuming the company has a limit of 40 million, so the balance is 40. Which project would you give the first priority? So we have ranked them. That's project A. So first of all, you have to take project A. Project A requires a capital of how much? 10 million. So how much is your balance? We have a balance of 30. Once you take project A, rank number 2 was project E. So project E requires a capital of how much? 18. So you have a balance of 12. So we still have some capital. So you can go to the next project, rank number 3, which is project C. Project C requires a capital of how much? 15, but you only have a capital of 12. Remember I told that the projects are divisible. Note number what? Note number 3. Each project can only be undertaken once, and each is what? Divisible. So if the project C requires 15 million, but you only have 12, you only need to invest that 12. We have 0. So in this case, we'll be undertaking. So undertake project A, E, and C. Also, you're taught you determine the resultant maximum NPV. So how do we get NPV? So you have undertaken project A, E, and C. How much is NPV for project A? If you undertake project A, will give an NPV of how much? Project A is giving you, yeah, 7.4083. What about project E? Project E is giving an NPV of 3.297. And then what about project C? This is giving an NPV of how much? 0.2155. But this is when you are take it in full. But in this case, we have already invested 12 million of the 15 million. So you multiply by 12 over 15, get the ratio. So can you give me the resultant maximum NPV? You are getting 10.87. Yeah, that's the resultant maximum NPV. So that's how we evaluate profitability index. So I want you at your free time. There's a question that we have been doing for May 2014. May 20, actually open that question. May 2014, question 2B. We answer now number 3. May 2014, question 2B, part 3. Yeah, the one we have been evaluating. So in case you don't have the past paper, just go back to the notes. And number 3 of the question, under the requirement, you have to compute what? Profitability index. So profitability index, we are saying that is the present value of cash inflow divided by present value of cash. We had project X and we had project Y. Let's go to project X. How much is the present value of cash inflow? Just use your notes. It's already in your notes. Whether you computed discounted payback period, just say the cumulative, the accumulated present value. That's the present value of cash inflow. It was total present value of cash inflow. 40, 294 point. What about project Y? 43, 598.9. Those were the total present values. Then you divide by the present value of cash outflow. Project X, we had invested 38,500. Project Y had invested 37. So give me the profitability index. $1.047. $1.17. So in this case, you don't have to rank because the two projects were mutually exclusive. Which one do you want to take between project X and Y? You are supposed to take project Y since it has a higher profitability index. And lastly, we have method number 5, which was internal rate of return. So that's why we start in our next class. That is tomorrow. Yeah. So kindly make sure you come with that document, the one you have been using, the notes, because even our next topic is under the same. Yes. So that marks the end of that class.